Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is accounting for long-term contract periodic losses. This is one of the hardest topics of revenue recognition, long-term contract. And we have three possible scenarios. Profitable contract, but with periodic losses, that is our video today, and a long-term contract with an overall loss. So we have three videos about long-term contract, and they are in our video description. Okay, so long-term contract, it is a special case of revenue recognition. So we have the 5 steps, and by the way, we have some videos about revenue recognition as well. Identify the contract, no problem at all. We have the long-term contract. Performance obligation. Usually it is a single performance obligation. For instance, construction and or okay, let's construct an office building, and then we have a single performance obligation because we need to deliver the building. Transaction price, cool. It usually is in our contract, so no problem. Allocate transaction price, single performance, no allocation required. However, recognize revenue when each performance obligation is satisfied. And we have two scenarios here. At a point of time, at the end of our contract, and over a period of time during our years. So let's go to our Excel file. Excel file here. Uh, and the Excel file is also free, and the link to download it is in our video description. So we have here three datas: profitable contract, partial loss, entire loss. So we have this Excel file. It is useful for all of our three scenarios. So let's delete it here. Oh, let's delete it here. We will do it together. Let's delete our journal entries here. So okay, we have these given numbers. Contract price $12.5 million. The cost 3.7 first year, 3.1 second year, 4.6 third year. And this is our billings, our cash flow. 3 million first year, 5 million second year, 4.5 million third year. So okay, let's go to the recognized revenue at the end of our contract. So we don't need these yellow numbers yet. So okay, let's do it. Construction in progress is just like an inventory. We are creating our building, but it is a long-term asset because we are creating it over 3 years. So construction in progress is our costs. 3.7, 3.1, 4.6. And the credit is cash or anything payable. Okay, and then the billings. Billings is our credit. Here, $3 million, $5 million, $4.5 million. And this is just like a deferred revenue. So the debit will be cash or anything receivable. Okay? Wow, they are not balanced here. However, what do we have here? We have our contract price is greater than our total cost. So we have a profitable contract. And then how do we find the revenue? The revenue is our contract price, 12.5. The cost is the total cost here. Total cost 11.5. It is not balanced. We need a debit here. Or we also need the gross profit. And the gross profit will be revenue less the cost of construction. $1 million. We will match this number later. So, okay, we need to balance it. we will balance with construction in progress. That is usually how do we also do when we are selling stuffs, but we do it in the opposite way. Okay, so how do we do that? 12.5 credit less 11.5 debit. We have $1 million. And then we have the same numbers here. They must match because our inventory here will match with our deferred revenue because we already have the revenue and cost of construction. However, we don't need this. We don't have this building anymore, and we don't have this deferred revenue anymore. So we need to close these numbers. So equals let's close it here. 12.5 debit 12.5. So we close our numbers. However, this is not a very good model because we have here we don't have revenues over the years. We have only one revenue at the end of our contract. So our info is not so good. The good info is, okay, how much is the revenue of 2018, 2019, and 2020? However, it is not the billings here. This is our cash flow, not accrual basis. This is cash basis, not accrual basis. How do we find it? We find the percentage of completion. And then how do we know we have partial losses? Usually, when our cost decreases here, usually, okay, maybe we have a loss, but we will find it later. It's much easier if we do it based on debit and credits. Okay? So to find our revenue, we need to find the percentage of completion. To find the percentage of completion, we have our actual cost, 3.7 million. We also always work with cumulative costs. Okay. However, how much is the total cost? The total cost is not the total cost, the actual total cost is the estimated total cost. So we need the remaining cost to complete. We will have for every year but the last one. The last one we don't have it because it's done, it's finished. Okay, at the end of the first year, the estimated remaining cost is $5.6 million. So the total cost will be 9.3. That is only the sum actual cost plus remaining cost. So the total cost here 9.3, and we can copy and paste these numbers, and we have the other years. And the percentage of completion, actual cost divided by total cost. So 40% at the end of the first year, 59 the end of the second year, and 100% the end of the third year. So, okay, if we have these completions, we use the same completion percentage here for our revenue. We have 40% of our contract done at the end of the first year. So 40% of our revenue will be recognized at the end of the first year. Prior periods, we don't have it because it's the first year. So revenue recognized in the current year, current revenue less revenue in the prior years, 5 million. So the second year, the prior year is the, uh, or sorry, is this our cumulative revenue from the first year? Cumulative revenue for the second year, 12.5 times 59. So this 7 million here, it is not the revenue of the second year, it is the cumulative revenue. So the revenue of the second year will be 7 million less 50. So 2.4 million. We can also find it based on this formula here. Percentage until the end of the second year less the percentage until the end of the first year. Oh, format it here. Go 19, and then 12.5 times 19. So we will have the same number. Okay? So let's also copy and paste here. Yes, so we have here the same. Perfect. Okay, and then third year, we copy and paste the formula here. We will have it. And then to double check if this number is right, we sum it. Sum it. We have 12.5. That is our contract price. So, okay, these numbers are right. So we will do the same as the completion here. However, we will be doing this journal entry here at the end of each year. So partial loss percentage. Wow, let's delete it here. We don't need, oops. Let's, oh, come on. Do it together. Okay. Construction in progress. The same journal entry as the completion is our actual cost. So 2018, 2019, 2020. Billings, the same. So billings, guys, this info here is completely useless for our revenue recognition. Okay, this is only the cash flow. Oh, for the cost of construction here, the cost of construction will be the same cost incurred during the year. So we will have, whoops, we have the same numbers here. Okay. So how much our revenue first year? The revenue is 5 million. Second year, the revenue is 2.4. The third year, the revenue is 5 million. So, okay, we must match revenue and costs. Okay, here we need a debit. Revenue greater than the cost of construction. So, our gross profit here will be 5 million less 3.7. Okay, 1 million and a quarter. However, this second year here, let's fill it with a blue, or not blue, red, and bold it here. What is our problem here? The cost is greater than our revenue, so we will have a gross loss instead of gross profit. And we need here a credit to balance this journal entry. So we need 3.1 less 2.4. Debits and credits explains everything, guys. So that's why it's so important. And this 1.2 here is our green one. And then the third year, we have profit again. The revenue is also greater than our cost. So we have gross profit again. 5 million less $4 million here. And here, it's not balanced. It is not balanced. So we need to close these numbers. So now it's easier if we do the sum in our deferred revenue. Whoa, whoa, whoa. Sum here, 12.5, closing credit to balance this journal entry. This first account here is closed. Same balance for debits and credits. Billings also closed. Same balance for debits and credits. And our gross profit here, let's do it in blue, 1 million. At the end of contract, the same 1 million. They will match, and they must match because this is the same contract. So the gross profit here, everything at the end of the third year, at the end of our contract. Here, we split it toward the years, so the sum will also be $1 million. Okay, guys? Oh, and by the way, when we compare construction in progress with billings, if Construction in progress is greater than billings. Billings will be contract out of construction in progress. We combine both. If the construction in progress is lower than billings, then construction in progress it becomes the contract out of billings, and then we have a liability. Okay? Okay, guys, so thank you so much. Oh, and by the way, here, a brief explanation about our stats. We did it in our Excel file. And here, the periodic laws and overall laws, we also did it in our Excel file. Okay, guys, so thank you. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Subscribe our channel, like our Facebook page, Accounting Hub by Dr. Scarping. Guys, have a very nice day and God bless you.